The Pros and Cons of 529 Plans by Jennifer Lang, Financial Services. Saving and paying for college can be a challenging goal, and you may be among the many people who worry about the financial pressure that funding higher education can bring. The cost of college continues to rise. For example, the average tuition and fees are $41,411 at a private school, $11,171 for state residents at public colleges, and $26,809 for out-of-state students at state schools. Thankfully for parents and grandparents, it's never too early to start saving, and there are many options to help you prepare for one of the most important milestones in the lives of your children and grandchildren. Let's first talk about 529 plans. A common option used for paying for college and educational expenses is a 529 plan, which is an education savings plan sponsored by a state or state agency. It has several advantages. 529 plans can be purchased not only by parents, but also grandparents and other relatives. Your earnings in the 529 plan grow tax-deferred. Any qualified withdrawals made are tax-free, and as a student reaches college age, the accumulated funds can be used to pay for qualified expenses including tuition, room and board, books and computer equipment. Many states offer tax benefits for contributions to a 529 plan. While 529 plans have many advantages and can be useful in preparing for the future, there are limitations to consider as well. An account can lose value due to market downturns. You pay penalties on any earnings if the money is not used for education purposes. Account earnings can affect an application for financial aid, and many plans include yearly fees and administrative costs. Plus, if your child receives a scholarship, you may only need a portion of the money saved in your 529 plan. If you end up with remaining funds, or if a child decides not to enroll in school, the beneficiary can be changed to another family member. However, if you do not have other family members looking to attend, you may have to pay penalties to withdraw your savings for other purposes, depending on the rules of your state's 529 plan. Next, let's take a closer look at the pros and cons of 529 plans.
529 college funding plans are tax-exempt savings plans, authorized by Section 529 of the Internal Revenue Code. But there are 4 drawbacks to 529 plans. 1. They count against the student's eligibility when applying for financial aid. 2. They have tax consequences if the money is not used for qualified expenses. 3. They charge administrative fees and investment expenses that significantly reduce the growth of your money. And 4. They can actually lose money because the mutual funds in which the money is invested are subject to market risk and performance volatility. For example, during the last decade, the 10-year period from 2000 to 2010, the S&P 500 stock index, which tracks the equities used in 529 mutual funds, increased in 6 of those years and decreased in 4. But the result was a net loss of 9%. So if you had been saving for college expenses with a $10,000 investment in the S&P 500 on January 1st of 2000, you would have had only $9,100 to pay for college expenses 10 years later on January 1st of 2010. What's more, the fees and expenses charged on 529 plans can further reduce the growth of your savings. In fact, according to the Securities and Exchange Commission, it is important to understand the fees and expenses associated with 529 plans because they lower your returns. Because most 529 plans charge enrollment fees, maintenance fees, and management fees, which can reduce the growth rate on your savings by as much as 2 or 3% every year. For example, if your 529 mutual fund were to earn 10% in 1 year, the actual growth rate could be only 7 or 8% after fees and expenses. And in years when your 529 mutual fund loses value, it would still charge the same fees and expenses. It's also important to know that you can only use 529 money for eligible college expenses, such as tuition, room and board, and only at an accredited school in the United States. So if your child should receive a full scholarship, or choose a foreign university or a technical training school, or simply decide not to go to college, your withdrawals from a 529 plan would no longer be tax exempt. What's more, the money in a 529 plan can reduce the amount of financial aid a student may qualify for by 5.6%. So how can you save for a child's college education without taxation, without the risk of losing your money, without limitations on how you use the money, and without counting against your financial aid eligibility? With a 7702 College Funding Insurance Contract, so called because it is subject to Section 7702 and Section 72E of the Internal Revenue Code, which allow you to earn interest on your savings without taxation, and also allow you to use the money any way you want, without any limitations or restrictions, through tax-free loans, guaranteed in the contract. But unlike a 529 plan, a 7702 College Funding Insurance Contract also guarantees that you cannot lose any of your money in mutual funds. What's more, the money in a college funding insurance contract does not count against the student's financial aid qualification. So ask yourself this. Now that you know the 4 major drawbacks to a 529 plan, does it still make good sense? Or does it make better sense to save, grow, and protect your college education money with a 7702 College Funding Insurance Contract? A contract that also gives you tax-exempt growth on your money and tax-exempt access to your money for any purpose, even if you don't use the money for eligible expenses, and all without the risk of mutual fund losses you get with a 529 plan?
Another tool to consider as part of an overall college saving strategy is a fixed or fixed-indexed annuity. A significant benefit of these products is your value can grow tax-deferred and is protected from downside market risk. So when the market is up, your money can grow, but when the market is down, you do not lose any of your hard-earned savings. Plus, if your child receives a scholarship or decides to pursue another path besides college, the money in your annuity can be accessed for other purposes. Keep in mind that annuities are designed to help you reach long-term savings goals. While most annuities allow you to withdraw a certain amount each year without penalty, you'll likely pay charges on withdrawals over that amount during the annuity's withdrawal charge period. This period typically ranges from 5 to 10 years or more, depending on the annuity. Account earnings can also affect financial aid, because the more you are able to save, the less financial aid you will receive. It's important to remember that withdrawals from an annuity may be subject to state and federal income tax. In most cases, withdrawals taken before age 59.5 will also be subject to a 10% IRS penalty. When considering this strategy, you should consider your age at the time you will withdraw funds to pay for college to ensure that you will be at least age 59.5 and will not incur the IRS penalty. As with many financial plans, there is no time like the present to begin saving. An annuity purchased when your children are young can assist with tuition costs down the road. One option would be to purchase an annuity with a withdrawal charge period that coincides with the length of time it takes for your child to reach college age. For example, if on your child's 8th birthday you purchase an annuity with a surrender charge period that ends in 10 years, your child will be 18 and entering college. At this time, you'll be outside the withdrawal charge period, meaning you'll have full access to the annuity's value to supplement tuition payments. Keep in mind that withdrawals taken before age 59.5 will also be subject to a 10% IRS penalty. Again, it's important to ensure that you will be at least age 59.5 when taking withdrawals from an annuity. A tax-free option for funding your child's college education is with the use of permanent life insurance. Permanent life insurance does so much more than help pay for college. It's the only source of college funding that provides lifelong benefits, no matter what happens in the future. The guaranteed death benefit means your child can go to college even if you pass away. Your policy's cash value helps pay for any college expenses. There are no restrictions on what the cash value can be used for. Remember, education savings plans can't be spent on computers, software, or transportation. If your child doesn't go to college, you can use that cash value for other things. And there are no time or age limits on using cash value, unlike 529 plans. To see if permanent life insurance is right for your family's needs, call us for a free one-on-one consultation. Graduating with student loan debt comes with tremendous responsibility, especially since interest continues to accumulate as time goes on. More than 2.5 million students have student loan debt greater than $100,000, and repaying those loans can be a significant hurdle. A tax-deferred way to help reduce a student loan balance is using income payments from an annuity. Over time, your premiums grow tax-deferred, and then at a later date, you can elect to begin receiving payments. Depending on the type of annuity you choose, you can receive income immediately or several years later. These funds can then be used to help reduce any remaining student loan balance. Remember, some annuities specify that you must be a certain age before starting income payments, and there are tax penalties for taking withdrawals prior to age 59 and a half. As you begin to take steps towards saving or paying for college, talk to a licensed financial professional about which solutions can help make higher education accessible and more affordable. By starting the conversation now, you can help bring the dream of your child's or grandchild's education within reach, while still meeting your other long-term financial goals. According to one study, most families say they would use their retirement savings to pay for their children's college education, if necessary. And 30% are planning to do so. This raises the question, should you tap into retirement savings in order to fund your child's education? Here are 3 things to consider before you dip into that pool of money. 1. Retirement is a necessity. But a parent-funded college education is a luxury. Your security during retirement should be your first priority. 2. There are many ways to fund a higher education. Scholarships, grants, help from extended family, and the contribution of the student are all potential ways to supplement the expense of college. 3. Consider a less expensive college option. Fulfilling some requirements at a junior college or choosing a state-run school may lower the total expense. We may be able to help you sure of your resources for retirement and college costs. But it is important to start now. Call today and let's talk about it. There are a number of strategies you can use to manage your financial future. You need a knowledgeable financial professional in place. And that's where Jennifer Lang Financial Services comes in. We work with over 20 of the best A-rated carriers. We can do the work for you to get the best rate and benefits for your individual needs and budget. Take advantage of our complimentary consultation today. We can help you put together a tax-deferred strategy to maximize Social Security, prepare for long-term care costs, and provide you with options for guaranteed lifetime income. Thank you for attending. Stay safe.